Okay, perfect, everyone. Well, I'm going to go ahead and get started as people start to join the webinar. Again, thank you for joining our webinar today on interest rates. My name is Misty Garza. I am one of the financial advisors located here in our Houston office. So today's topic is going to be about interest rates and specifically how they are moving and how they impact your lump sum at ExxonMobil. If you are not currently an ExxonMobil employee and you do have a pension that is subject to interest rates, this would still pertain to how they are moving and the impact those might have on your current pension payout options. So we do have a little bit of a chat Q&A feature that you guys are welcome to use. I will go through those if I see those pop up throughout the webinar, and then at the end I'll go through and make sure that we answered all of those questions. So please feel free, if you have some questions there, to post those in those boxes there. So again, let's get started. So again, welcome to our interest rate seminar, and going to talk about the impact of the current situation with the interest rate environment right now. So a little bit about us. So for those of you that are new to our firm, our mission here is to help clients achieve financial peace of mind. A little background on us: we have over $2.8 billion in assets under management. We work with just shy of 1,300 households right now. We're a registered investment advisor, which for you as an individual means that we're an independent fiduciary advisor. And fiduciary is something that a lot of people throw around in different terms out in the investment world. And it really just means that we are here to work in your best interest. We custody all of our assets at Charles Schwab for your protection. Nothing is under specifically Bogart management accounts. We're a fee-only wealth management firm. Bogart Wealth has financial advisors located across all three of our different offices, with McLean and our two Houston offices. If you have noticed, we have been growing rapidly over the last couple of years. So these lots of different slides with lots of different partners that we have here at our firm. We also have our own in-house client service and financial planning team as well within our Virginia and our Texas offices. And we also have in-house marketing, compliance. Again, they're headquartered in our corporate office in McLean, Virginia. We manage our assets in-house here. So this is our investment team. Alex Spencer heads up that. And we also have a local CPA firm here in Houston that we do partner with for our clients as well, who we are providing some of the tax planning services for them as well. Our headquarters, we have three offices. Our headquarters is in McLean, Virginia. I'm located in the Houston, Texas office here on Gessner in the Memorial City area. And then we also have our Woodlands office as well. So for those of you that have worked with us, you know that planning is at the heart of what we do. And so most people think that planning for retirement is just about the investment management piece. And obviously, you know, interest rates play a role in that. It doesn't specifically related to investments. So it's important to look at the retirement analysis, your cash flow withdrawal strategies. All of these pieces work together as we are creating a plan for you and your family based upon whatever goals it is that you are trying to achieve. Everything is client specific to each individual. Everybody's situation is different. This is not a one size fits all. Your goals are very different than maybe your coworkers' goals or your neighbor's goals or other family members' goals. So one of the things that we do is we focus on what is it that you and your family are trying to achieve, and then we manage those issues that are important to you. Obviously, today's topic with interest rates is very important when it comes to your retirement analysis and making those retirement decisions. If you're new to Bogart and you've not gone through our planning process, I would encourage you to reach out to myself or one of the other advisors that you might be working with, and we can talk specifically about what it is that you guys are working on. We also produce a number of educational webinars. This is relatively new. Our marketing team has been busy putting lots of things together for us. And so if you head over to our website on bogartwealth.com, looks a little different as we've been changing that up and adding all of these new resources for you. We have a retirement readiness series that's topical based upon different issues every month, issues that are current environment issues that people are looking at from a market standpoint, as well as issues that we're finding that our clients are wanting to know more about. We've also created a podcast. So our podcast is listed on our website to where you can find that. Again, very topical based upon different things that people are working on as well. All right, so let's get started on how do discount rates affect your lump sum. So one of the questions that comes up is which discount rate applies to me? So at ExxonMobil, there are two discount rates. One is there's a general rule, and then there are ones for folks that are grandfathered. And so what I would like to let people know is almost everybody here needs to remember it's the general rule. And the rate that is in effect on your benefit commencement date is the one that applies to you. Okay. Your benefit commencement date is always the first day of the month. It doesn't matter if the first day of the month is a holiday. For example, if you're looking at getting a second quarter interest rate, then your benefit commencement date at the latest has to be June 1st. Once you roll into July 1st, that becomes third quarter. One of the questions that a lot of people end up having is the benefit commencement date. And so there are basically three dates when you look at retiring. There's your last day of employment, which is the last day that you're on the payroll. And then you have your first day of retirement. And so your first day of retirement is always after your last day of employment, your last day on the payroll. Now, benefit commencement date, when we're talking about retiring and electing your pension, you do not have to elect your pension on that benefit commencement date, so on that first. And so one of the tools that we work through with people is how to kind of go through what the interest rates are doing and making sure that you choose the most appropriate benefit commencement date based upon where the interest rates are and what it is that you and your family are trying to achieve. So one of the things to think about, so that's the general rule for most people. And then if you are grandfathered, there are a few other stipulations as far as what you get to choose for your benefit commencement date. You have the option to choose the interest rate on your first day of retirement or that benefit commencement date that the first available first of the month. And so what that means to you is, again, I don't want to get too much into the weeds of grandfathered because there's not a lot of people there. But for an example, if you were to retire, your last day of employment was on June 29th, that means your retirement date would be June 30th. So that puts you as your retirement date in the second quarter. But then your benefit commencement date could then be that July 1st. Which would be that following month. So for those individuals, they could choose which interest rate is most beneficial to them. Again, I kind of, if you are part of that group of being in the grandfathered group, just let us know when we would work through what that means to you. But a lot of our focus here is really going to be about the general rule that impacts most people with the current interest rate environment right now. So a lot of this took into effect with the Pension Protection Act of 2006. It actually went into effect in 2007. And the most important part of this is that it put limits on companies who provide lump sums. Basically, pensions have to be funded at least 80% in order to offer the lump sum option. So if their funding level drops, then there can be some changes to the pension payment options. It's not ever happened to Exxon, so we don't worry about it too much. Pension plans are always very highly regulated. They're always keeping up on the funding levels. But that was part of what this act was there to do, was to define what those lump sum options were. It also defines which discount rates can be used. It defines the actuarial tables that are used. Companies are required to update their actuarial tables every 10 years. The last time the table was updated at Exxon was 2018. Just because a new table comes out every year does not mean that they have to use that table. They just have to update it within that 10-year period of time. So the last one was done in 2018. So the next change that they will be required to do will be in 2028 if they have not made any changes prior to that. A few other little things that the Pension Protection Act impacted, but really not related to what we're talking about today. So really quickly, let's talk a little bit about who that grandfather group is so that you know who you are in case we have some different interest rate rules that we need to look at. So most likely you have to, if you are younger than 66 and have had less than 26 years of continuous service, you are not part of the grandfather group. So there are a few people who are still 66 and have 26 years of service, but not a lot of those that we see. So just know if that is you, you do have a different interest rate calculation that we are looking at. So basically what happened was the companies were given the choice to either fully, phase in these new rules or just do one fell swoop. So Exxon went in, just did the one fell swoop. So this is where these age and continuous levels of service came into play. So at the end of 2012, you had to have been age 55 and had 15 years of service, which is where we get that 66 and 26 years of service right now. So for those people, they're using the Treasury bond. It's 95% of the 30-year Treasury bond, and they have different mortality tables as well that they get to use. So a couple more slides, a little bit about showing you where interest rates are for the treasuries. So these are the ones that impact the grandfathered individuals. Really, this chart just kind of shows you where the treasury rates have been going back to 1980. So a lot of people think that we're going to go into where we've previously been at some of those all-time highs. And we have been at some of the historic lows. Now they have been moving higher, but are we going back to where they were in the 80s? We got a long way to go before we were to get back to that level of interest rates. So here's where the current interest rates are for those grandfathered individuals that are using those treasuries. So basically, one of the biggest distinctions that they have is that when they look at the interest rates for that quarter, so take, for instance, the first quarter here, every day counts. So it's very important to look at what is going on every day of the month. It's a big difference for what the non-grandfathered people end up using. So we calculate every day to figure out what that looks like and take 95% of that treasury, round it to the nearest 0.25%, and that is your discount rate. So relatively easy for those individuals. And treasury rates move differently than the rates that are in effect for the non-grandfathered by using the corporate rates. Okay, so let's move on to all of the other people, which is who this impacts typically the most. So for those that were under 50 and had 10 years or less of service on December 31st, 2007, these are the new rules that apply to you. And so these new rules are based upon corporate bonds instead of the government bonds. And there are 3 points along the yield curve that we look at those rates. If you want to track them, you can track them with the IRS. I have the website address here. It takes a little while for the IRS to update them on their website, but the Treasury Department puts them so we can kind of see them before they are officially posted on the IRS website. Now, one of the biggest things, the biggest differences is that corporate bonds have higher yields than government bonds because they're considered riskier. And so the higher the yield and the interest rate is, then the lower that makes your lump sum pension. And we'll get into the details of that. So that's been the biggest distinction with this change, is that treasuries were typically always a little bit lower than what the corporate bond yield rates were. Again, there are 3 different segments that we look at for these interest rates. We are also using the IRS mortality table that's updated every 10 years. And one of the things that we want to look at is a longer life is good for a pension calculation. Okay, so I want to show you a little bit about what these 3 segment rates have been doing over time, so you can see the movement between the 3 different interest rates. So I'll go back to 2013. This is when we started tracking all of these with the new Pension Protection Act. And so you can see there are some big differences here. So segment 1, which is the green, is short-term rates. And so short-term rates are typically 6 months to 5 years. Okay. And then segment 2 is going to be your more intermediate, which is 5.5 years to 20 years. And segment 3 is 20.5 to 60 years. Now, this comes into play when we're looking at mortality and looking at the calculation of how old you are and how long you're going to be receiving benefits for your pension. Okay, so you can see that rates go up very quickly and they can get compressed as they've been going up quickly in the current environment. Okay, so one of the biggest distinctions here in this group is that only the last 2 months in the quarter are used in the calculation. Okay, so for instance, January for the first quarter doesn't pertain to any of the calculations. It does give us an indication of where rates are headed. So as we are in April, so this is the first month of the second quarter, April's rates do not impact what's going on in this quarter here, but it can give us an indication of what May and June's rates might be. Okay, so we track the daily rates for each segment, and then we compare that to the market data that's published by the IRS to try to get a prediction of what is going on. So you can see what we were looking at. We just wrapped up the March rates, and so they weren't official when we did this. So these were our projected rates here for segment 1, segment 2, segment 3. So you can see they were very much somewhat in line with what we thought in January, but they did creep up just a little bit as we ended up March. So we track all of these so you can see the segment rates for your benefit commencement date. Okay, so here's some of that same data of watching that segment history, but in a little bit of a different format, because it's difficult to look at these numbers and decide on how big of an impact does that have on you. And so as you'll see here in the chart, looking at your benefit commencement date, so people who were electing a benefit commencement date in the third quarter, they're looking at these first quarter interest rates. If you're looking at the benefit commencement date in the second quarter, then we are going back to fourth quarter's rates. So we have a little bit of a way to kind of decide what direction are the interest rates moving. Is there going to be a better time to elect your pension option if you have not made a decision when you retire? So what we've done is to figure out how to see what this biggest impact is of these 3 different segments, is calculate what's called a single equivalent rate. And so for those of you that are in that non-grandfathered category, we calculate that specific number so we can make a comparison a little bit easier on what's going on from quarter to quarter of those interest rates and how does it specifically impact your lump sum pension option. Okay. There's also a difference between people who are electing at 60 versus electing at 55. Again, all of this is based upon the mortality tables and how long we're going to live. We'll talk a little bit about kind of the impact of those 5 years as well. Okay, so just a quick little history to show you what the trend has been as we have been in a little bit of a higher rate environment than we previously had. So these only go back to 2013, but we took the same method that we used to calculate this and we kind of backcast it all the way to 1984, just to give us an idea of what has the trend been. So you can see that the rates have moved up quite a bit from their lows. They were at the bottom during the pandemic time. Rates were at the lowest they've ever been in U.S. history. So they've clearly increased since then, since 2022, and they look to be higher than the average that we've had in previous decades. We don't know for sure what caused such a downward trend during those periods of time. And so we don't know where we're going to end up, and we don't know if we're going to create new highs or new lows as well going forward. Okay, so now that we've addressed what the interest rates are that we're using, so now let's talk a little bit about how these interest rates affect your lump sum. Okay, so that's what the next few slides are going to talk about. So here we're showing a simplified example that illustrates very clearly the impact of age at retirement, life expectancy, and interest rates. So this doesn't get you the exact amount of the lump sum, but we were trying to get as close within about 10% or $10,000 for every $1 million. So basically, the current mortality tables has a 60-year-old living until the age of 84. Okay, so in this example, we have assumed someone is getting an annuity for $76,000 a year. Now, we contrived that number because we wanted to get the lump sum to equal $1 million to be able to show you the impact of what happens at $1 million. So basically what we do is that we put in those interest rates, those segment rates, segment 1, 2, and 3, in at those different periods of time. So starting at age 60, we're going to have first 5 years of segment 1, and then we're going to have segment 2 for years 6 through 20, and then we're going to have segment 3 potentially on the back end here at the end. Okay, so you can see in this example, based upon how old you are, which segment might have the biggest impact. Because for somebody who's retiring at 60, that segment 2 rate makes up the largest portion of the interest rate calculation, as well as those on the back end. That segment 1 rate is a very small percentage. Okay. So what we do is we put in those interest rates, and we calculate whatever the discount factor is that we would need to invest today in order to create this income stream. Okay. And so when we calculate that back of what we would need today for that, then it equates to be the $1 million equates to a single equivalent rate of 5.44. Okay. So that's what we're doing, is back calculating what would we need to invest today, what interest rate would we need to get in order to create that income stream. Okay, so that's the 5.44 that we are looking at of that single equivalent rate when we go back to this chart here. There's the 544. Okay, so now what happens when somebody's younger? So a lot of individuals who retire prior to 60. So we backed this out to age 55, which would be would allow somebody to be retirement eligible if they have enough years of service. So the same discount rates apply, but their annuity actually only shows 75% of what it was before, right? Because they do not get the full annuity if they take it early prior to 60. So we've backed out that to 75% of that annuity of 56,000 there. Okay. So life expectancy is actually 1 year shorter. Okay, but you're also getting more years of annual payments. So you start at 55 and you actually receive the annuity payments through age 82. Okay. So retiring early and electing the lump sum pension, it's not an insignificant amount, but a lot of people will equate, those 5 years to be 25% exactly. But when you actually run the numbers, it equates to be more around the 3% range. So, okay. So what you'll notice here is that a person who's retiring at 55 will have more years in segment 3. Okay. And so they're going to be a little more sensitive to what's going on in segment 3. Again, looking at which rates are most impactful to you and which ones are a little bit higher and which ones are lower. Okay. So again, in this example here, the single equivalent rate is the 5.45. So we would only have our lump sum pension value would be about $805,000, okay, in order to equate to that. Okay, so I'm going to shift gears a little bit and talk to you about how you can calculate your own single equivalent rate. And there's 2 different ways. So some people who are Excel spreadsheet friendly and love to go in and do a few things like that, have a little bit of ways on how you can calculate your own internal rate of return by using the goal seeking method here. You guys can go back and rewatch this if you wanted to be able to calculate your own with the spreadsheet. But basically, you're just looking at, putting in the lump sum amount in that first case, negative $1 million, and it's negative because you're buying the annuity, and then every year you're getting the $76,000 out of it. And so you're going to use the goal seek method here to kind of get the same answer. But we are happy to do all of this for you as well. But if you wanted to kind of do that on your own, this gives you a little bit of way to do that. Okay, so kind of one of the bigger questions for a lot of people is how big of an impact do those interest rate changes have on the lump sum? So now remember, keep in mind, we looked at, depending on how old you are, different rate segments can have a little bit bigger of an impact. But when we look at it in the big picture, let's assume someone is retiring at age 60 in the second quarter here, okay? Their single rate equivalent is 5.44. We're assuming they have a lump sum of $1 million at 60. And so when we look at where rates are moving, when you look at if rates increase by about 1%, you have about a 9% change in a decrease in your pension. If interest rates decrease by 1% overall, this internal rate of return here decreased by 1%, you have about a 10.3% increase in your lump sum value. So in our mind, we kind of view it by every 1% change in the interest rates reflects about a 10% change to your pension. So if interest rates drop by about 1%, it should be about a 10% increase in your lump sum value. They increase 1%, you would get a reduction of about 10%. So that's the way we typically view it when somebody wants to just kind of look at really quickly, where do we potentially expect interest rates to be, and what is maybe the impact of what that lump sum value looks like. Okay, so basically this just kind of shows you, we just kind of showed you how that math works. So that same example of where interest rates were, if interest rates dropped just slightly for that person who was age 60, their lump sum was valued at about $1 million. The new valuation would be $1,021,000 and some change. Okay, so interest rates changed about 0.22%. Is that. So again, you can just kind of see a little bit of that impact there. Okay, so one of the things to think about is, given the current interest rate environment and where interest rates are, is when would somebody consider delaying the pension? Remember, I talked a little bit about one of the misconceptions is that people think that they have to elect their pension when they retire, and you do not. You, again, remember that benefit commencement date is based on electing your qualified pension, which is what we're talking about here. So you still have all of the other things that you need to do with Exxon as far as getting all of your medical benefits elected for retirees and all of those kind of additional things that you might have to take care of if you have any additional pension plans or 401k plans. But just related to electing the annuity or the lump sum, you do not have to make that decision when you retire, okay? You can choose to delay it. So everyone's situation is different. And so depending on whether or not, one, you're taking the lump sum or the annuity or a combination of both, it's really a conversation that you need to have with your advisor to go over the pros and cons of each of those options, okay? If you are choosing to take the combination of an annuity and a lump sum, you don't get to choose one and then delay the other one. So you are electing that full choice. So you're electing whatever pension amount is and what that lump sum amount is at that time. But if you are choosing to take 100% lump sum or 100% annuity, then you can choose to delay that. And so, again, it's really important to talk about what your goals are, what your risk tolerance is, what your overall plan is. If you don't need the money right now, if you're retiring before 60, or you're expecting interest rates to fall, or we are seeing the trajectory of where the interest rates have continually been dropping, then you might want to talk through your decision to make sure that you understand what all of your options are and what's best for you and your family. I feel it's just really important for you to just make an educated decision on what's going on and talk through those decisions sometimes I will find that some advisors that you might go to, they'll see your lump sum pension, and of course, they just want you to make that election right then and there, which might be the best choice for you, but it might not be the only choice that you have. Okay, so let's talk a little bit about timing and preparing for retirement with the decisions that need to be made. We have a nice, pretty little picture here that goes through kind of that roadmap of some of those election choices. But I'm going to flash forward more to a little more of a little more nerdy version that specifically kind of lays out the dates. So if somebody was electing a September 1st benefit commencement date, so this is the third quarter, it's the last benefit commencement date. If you're wanting to make that pension election, you would have to have your last day of employment prior to September 1st. So September 1st would be that BCD date for you. So basically about 90 to 120 days out, you can kind of start to put things in motion if that works, based upon what your job role is. If you're able to give that level of notice, you're not required to give that, but some people are in roles where they do need to have a backup or start training somebody there. So about 90 to 120 days out, you can inform your supervisor of some key dates and kind of start the process of making some of those elections. Now, for a lot of people that we work with, we've already done all the projections. We already know what we're going to be doing. This is purely a matter of, now that I've made my decisions, what's my timeline to get these things going? So once you've notified your supervisor of what's going on, then around end of May, about 2 months out, you can receive your intent to retire package. So you can call the pension benefit group. A-Light is handling all of that, and go through some of the numbers, make sure they all look good. Some people still have an online election that they can choose, and then other times there is some paper that we need to fill that out. So you receive your intent to retire package, you meet and review all of those documentations. Sometimes there's some notarizations that are required there. And so we have a list of what some of the forms are. You're making your election form, whether or not it's your lump sum or your annuity. And if you are rolling it over, you have the rollover form. There's an address verification form to verify where you live and your state of residence. And then if you have non-qualified pensions, election forms. Now, if you are not electing your qualified pension, so this lump sum pension, then most of what you're doing is just working through some of the medical, some of the non-qualified pension options that you have there. You're just not going to elect any of the qualified. And on the new pension election forms, what we've seen is there is a checkbox that says you are choosing to defer your qualified pension at this time. Okay. So typically there's always some paperwork that you need to fill out. So make sure that you've contacted the pension benefit group and kind of worked through that. You typically, if you are electing your qualified pension, you typically want to get that in 35 days prior to the benefit commencement date. Now, what that means to you is that just means that if you are having a benefit commencement date of September 1st, then if you get it in 35 days prior to that, then your pension would pay out on September 1st, okay? If you happen to decide later and you don't have those 35 days to get it in, or there's just something wrong with your paperwork, doesn't mean you're not still going to get that interest rate calculation at that date. It just means your payment might be delayed, okay? So a lot of times we just want to make sure everything is in good order, and we like to have it in 35 days for them to review it and approve it and make sure that payment goes out, because they only issue that payment once a month on those qualified pension plans, okay? And then also during this period of time, you want to make sure that you have all your medical benefits and everything taken care of as well, okay? I do have somebody who sent in a question about if you have the supplemental pension or the APP plan, the non-qualified pension amounts. Yes, there are some different benefit commencement dates for some of those. We've seen some of those be delayed, and there's some other things kind of going on. And then at different levels within the organization, some of those non-qualified pension plans do have some different interest rate calculations and payment dates as well. So that is very specific to each individual. If you do have APP or SPP, there might be some different payment dates that you would get on those. So once we've made all of our elections, we've gotten everything turned in. This is kind of that timeline that we talked about. If we've met those deadlines, that your lump sum rollover check does get sent to you in the mail. Okay, it's not made payable to you if you've elected to roll it over. So then at that point in time, you would just then pass it off to the financial institution that is going to be handling that for you. And then for us specifically, you know, a lot of times we've already kind of gone through some of the cash flow investment tax NUA planning at this point. Maybe we haven't. Again, it just depends on how much time we've had. If we've been working together for a while, we probably have decided on this. Other times, if it's a retirement decision that's happened fairly quickly, or the market's been moving, or something has changed in your life, maybe we are finalizing that and wrapping up a few of those loose ends there. Okay. Now, once you have retired from the company, typically, I would typically say a little bit more kind of on that 10 days after retirement, you can then have access to rolling over your Voya savings plan if you so choose. Most of the time, if you're going to roll it over, we just want to make sure that all contributions have been posted via payroll and the employer match, all of those things. Again, this is an important piece. Once you retire, you are not required to roll your money out of Voya. So that can be a decision that you can make on what works specific to your situation there. Lots of things to consider of whether or not you leave the money behind or you roll out of the plan, or how you might manage the gap from potentially retiring early and then not having access to funds until 59 and a half if they're in an IRA. So a lot of conversations to have with your advisor in regards to this, but typically that'll happen about 10 days after you have retired. And then a little bit, 10 to 15 days after you have rolled everything over from Voya, that's what this is referring to. There's a period of time while that money is in transition. So the pre-tax dollars out of Voya, they can actually express mail those to you or to a third party as well. So those can be received fairly quickly if you're wanting to diversify out of the plan. You can keep ExxonMobil stock as ExxonMobil stock. That takes a little bit of a longer period of time to do that. And then if you're utilizing NUA, again, a little bit of a different time frame for all of that to get wrapped up. So if that's something that you're working on, we could go over the specific things to expect on how that process works during that period of time. So it does take a little bit longer for some of those NUA shares or any of the IRA shares to roll into an account after that. Okay. Let's see here. Okay, moving on. Okay, so some of the things to kind of think about as we've kind of gone over all of this, I think is one of the things is that as you go into retirement, have a plan, right? That's one of the most important things is this is not something that you want to just suddenly decide and have not really run the numbers and made sure everything works for you. I mean, most individuals have done that. It's never too late to start, you know, and so you always want to talk about that. Know what the rules are, educate yourself so that you don't make any mistakes. So that's our biggest thing is working with, we don't want you to look back and say, I wish I would have known this, or I wish I would have done this. We want to help educate you on what your options are and help talk you through what is the best choice for what you and your family are working on. So that's having a plan, creating a budget. One of the biggest things is that if you have not budgeted while you've been working, because you just have a steady paycheck that's coming in, sometimes people don't know what their cash flow needs are and what they plan on spending in retirement. And so it's very important to know what you're going to need. Do you need your whole paycheck replicated? Do you need more than your paycheck replicated? A lot of times you'll hear a lot of people talk a little bit about the go-go years, the slow-go years, and the no-go years. Those are very real. I will tell you that most people, when they retire, end up spending probably a little bit more than they expected in those first couple of years. You know, certain things do fall off, but a lot of things do go up, or you have more time on your hands. You have more time for hobbies, whatever those may be. And so a lot of times you are spending more. And so there is a period of time while you are younger, everything is new, your health is good, and we're spending a little bit more. So a lot of times when we're doing some of our cash flow needs, we really work one-on-one on what's important, what do we want to do in those early years. And most likely it's some level of a stair-step approach to where we're going to be spending a little bit more, maybe for those first 5 to 10 years or whatever your situation allows, and then a little bit of a slowdown. And then at some point, we're not as active. And so maybe our medical expenses are a little bit higher, but we're just not spending as much there. The other part of it is understanding your risk profile. And part of your risk profile is based upon your cash flow needs and what you need. So if you are going to have significant investments to cover your retirement goals, then that can ultimately allow you to have a more conservative risk profile. And you might want to do that. If your goal is to leave a legacy behind, or be able to give to your family members, to charities, maybe you want to grow your money so that you do have more money left behind for those individuals. So again, a lot of time, depending on what your goals are, what your cash flow needs are, is going to help dictate what that risk profile is and how we segregate the different buckets of money to fund those periods of time. Okay. And for me, a lot of the risk is there's a financial component to it. We can look at your plan and say, this is what you need to be successful. You need to return 5.5% in order to achieve your goals. But for some individuals, there's another component that's the behavioral and the emotional side of risk tolerance. Not everybody is comfortable being in the market or seeing their accounts fluctuate. And so we have to make sure that we understand your comfort level with the market. The market is extremely volatile. And a lot of times when people retire, their risk tolerance changes. When we are working, we're accumulating dollars and we're adding money to our 401k every paycheck, and the company is matching. And so sometimes we don't really understand how that portfolio has been moving because we've been adding to it. So we never really see some of the negative downturns in the market. But once we are retired and we are living off of our assets and we're not adding anything to it, sometimes it can be a huge wake-up call for people's expectations and their comfort levels with the market. So it's important to kind of know what that is to use so that should the market continue to be volatile, that we're going to make sure that we maintain our investments and don't make rash decisions based upon what's currently going on. So some of the things to kind of think about when you are looking for an advisor as well, a lot of times, you want somebody that's going to be open and just discuss various strategies for you and not just have, this is the way to do it. Again, not a one size fits all for everybody. Your situation is very different. So you want somebody that's going to help give you your options, but then also tell you based upon what you've discussed, which one they think is the best choice for you. And they're going to provide those planning needs, regular portfolio performance reporting for you. And you just want to find somebody who you understand and that you enjoy having those conversations with and meeting with. This is not something that typically, as you're going into retirement, that we work through retirement and then that's it and you go on your way. This is typically about building a relationship, making sure that you stay on track for retirement. And so what I think is important is that as you're managing cash flow and managing your investments through retirement, it's my job to make sure that you stay on track. And so that if I see you starting to get off track or I see something going on, whether it's investment related, market related, or cash flow related, to have those conversations, because I want you to be able to make decisions and make adjustments as needed rather than waiting until it's too late there. So again, when you're thinking about managing all of that, certified financial planners, again, looking at all of those aspects of planning, they know your retirement plan. It's something that you guys are working on one-on-one. They know the IRS rules. We've navigated all of this through multiple business cycles, and then, kind of managing through that as well. If you have not worked with us before and kind of done a one-on-one financial strategy session, we are more than happy to do that with you. It is complimentary. We don't charge any fees for that. And so we will work with you, go through your plan, and help give you some guidance on what are some of the best decisions and the best path forward for you in regards to that. So again, on our website, you can find all of our different contact information. You can call our main number toll free. And then here's the 3 different options for our offices as well. Again, so I'd like to kind of thank everybody for joining. I'm going to go through some of the questions and things like that to see if there's anything that we didn't answer. But one of the things I would encourage you to do is that we have lots of content on our website. So LinkedIn, Instagram, we have a YouTube channel, we have the podcast now as well. So we have a lot of information that you can go to and find out what's most appropriate that you want to learn more about or what pertains to your situation as well. If we have a monthly market call as well, if you are a client of ours, and we do post a lot of things on your Black Diamond. So I would encourage you to be able to go to Black Diamond and look at some of those things as well, with some links there too. So, so one of the questions says, is there a limit to how long you can defer the lump sum for? There is a limit. It is depending on when you leave. Typically it's 65 plus as far as deferring the lump sum. And so a lot of that depends on how old you are, because when you think about that calculation of what that lump sum, if you're going to take the lump sum or even the annuity, there are more advantageous times to not delay it depending on how old you are. Again, because those calculations are based upon your mortality and how old you are. When we look at like if you retire at 55 and you have not made a pension election by 60, okay, as you get older, your period of time of payments starts to go down. Your life expectancy starts to get shortened. So when they're calculating your annuity, then they don't have to pay you as much, right? Because now you're not going to live as long during that period of time. So your lump sum can start to go down just because you might be getting older at a certain point in time. So again, one of those things to kind of think about. And then also if you're choosing the annuity option, again, it can be based upon how old you are. If somebody retires at 60, your full annuity pension option is at 60. So you would elect it at 60. If you are working and you are 62 and you're still paying into the pension plan, your pension plan might not be moving too much. Again, right, because your mortality, your lifetime payments is shrinking over that period of time. So most of the time, if somebody has retired early, and when I say early, prior to 60, if they are choosing to defer their pension, they're probably not going past the age of 60 for whatever reason. Again, maybe there's some instances to where you would choose to delay that, but most of the time, if you're retiring early, most people are delaying it, but not going to go past 60 to make that election. Another question says, do we work exclusively with ExxonMobil clients? No, we do not. We do have a lot of ExxonMobil clients, so we are very familiar with this plan, but we are experts in the whole financial planning, retirement planning process. So I've been doing this for almost 25 years, and my focus has always really been more on the retirees and the retirement planning process of it. So we work with everybody. If there are specifics with another firm that has their pension options, then we are very familiar with what those mean and work with those individuals as well. We will also, one of the things that we work with our clients too, that is very important when we talk about, leaving a legacy and building this intergenerational wealth, which is part of our mission, is making sure that if we're working with our clients that we help educate their children and all of those, because that's the next generation of who might be inheriting that wealth. So it's very important for them to be on the right mindset from a financial literacy standpoint to make sure that they are able, and we are setting them up to make good financial decisions as well. So I'm going to leave it open for just a little bit to see if any more questions come through. Otherwise, I did not see anything else. Let's see. Okay, so one of the questions says, what do you recommend with the current interest rate reduction predictions while deciding to defer a bit? So that's the $1 million question, right? Is that we don't know exactly what's going to happen, and there's no guarantees with the stock market. So that's definitely more of a personal choice based upon your risk tolerance. Okay, we with interest rates where we were at, interest rates are staying higher for longer, given this current environment. So we don't know. There was a period of time where last year we thought the interest rates were going to start to come down, and they actually crept back up. So one of the decisions is based upon, again, looking at your age to figure out, is that impacting what that calculation looks like? Your risk tolerance. Your risk tolerance is huge, because if somebody is choosing to take a lump sum, and depending on what we're going to do with it, that could impact, can they make up that difference, right? So the idea would be that if I want to hang around and wait for interest rates to drop 1% so that I can get an extra 10% of my lump sum pension, there's no guarantee, right, that 1% is going to happen. That 1% could happen very quickly. That 1% could take 2 years to happen. So the other side of that would be, some people could choose to elect their lump sum pension today in the current interest rate environment and say, you know what, I'm hopeful that I can invest that money and make up that difference faster than what the pension is going to be able to do. And so to that, one, there's no guarantees, right, in the market. The only guarantees is cash. And again, we don't know how quickly those interest rates could go down as far as what you're able to get off of that. So that's a conversation on what's your risk. I would say that if somebody is a conservative investor and not looking at taking on a lot of risk, you might want to defer it a little bit. But again, everybody's situation is different. If somebody wants to take the risk of saying, I think I can get there faster, and they're willing to do that, again, no guarantees, but a lot of people find that that's their avenue, and that's what they want to be able to do. And so we're definitely here to, again, like I said, kind of lay out all of those options, help you make an educated decision. One of the things that is good about being able to look back 2 quarters when you look at the interest rates is you can see a little bit of a trend, so that if the trend looks like it is going down, we could potentially see how quickly it might be going down. Or in 2022, when the interest rate spiked, right, there was a lot of people who said, well, this is what the next quarter's interest rate looks like, so I need to go ahead and get out of here now in order to lock in this interest rate. So you can play a little bit of that, but no guarantees. So I think it's a little bit kind of more of a specific one-on-one question as well. And then somebody asked me, do I forecast life expectancies to increase due to medical advances or decrease due to COVID in the next release? I believe they've gone down just a little bit. I think it's a give and take on that. I see both sides of that with the tables. And so it's just a matter of when they want to take on the new tables, right? So they got the tables in 2018. They have 10 years to do another one. So if they wait until 2028, or they could choose to adopt new tables there. Yes, life expectancies are increasing due to medical advances. So you are living a longer life, which again, when we think of that, that's that segment 3, right? That's pushing those out. And segment 3 rates are typically always a little bit higher, or those can have the biggest impact if we start to see those move. But there also is the fact, I think we're kind of potentially past the overall hump of life expectancy decreases going down due to COVID, but I know that there still are some issues there. So I think it might be maybe a little bit of a wash, maybe an extra year or 2 potentially here or there. And if just a year or 2 is changing, you're probably going to have more of an impact of what the interest rates are doing, not so much on the mortality tables. Let's take a look. I'll give people a little bit more time just to see if there's any other questions, but I think that might have been the last one there. So again, I would encourage you guys to visit our website, bogartwealth.com, if you wanted to rewatch this video or watch any of our other videos, or reach out to any of us here on the team. We are more than happy to help you with any of your questions and scheduling a one-on-one session if we have not done one of those before with you. So I would like again to thank you for attending. Again, have any questions, please let us know. I hope everyone has a wonderful day. Take care.